Good afternoon, traders. This is Christian from Market Trade Group, and this is your end of day video for, I almost said Monday, but it is Tuesday. Remember, we had Monday off for holiday, so it is Tuesday, February 21st. Well, wasn't the normal turnaround type Tuesday market. Today was kind of a continuation from what we saw last week. And a couple of catalysts that I have written down, which we've been talking about now for a couple of weeks, but interest rates continue to climb. That's kind of just across the interest rate curve. I'll go over a couple of those charts so that you can kind of see what's going on there. Bad breath, that's also something that the market has been plagued by for the better part of February. We've seen that NYSE crossover, which is the NYSE McClellan summation index, as well as the NASDAQ. Those have both been pretty good signals because that really provided a kind of change in tone for the market, and the market has just continued to go that way. Before we get to any of that, risk disclaimer in front of you. Everything that we're going through is for information purposes only. Please read the full risk disclaimer here. So you can see the damage was done. You could see small caps really got hit today, down 2.9%. Also micro caps, that's IWC, that was down over 3% for the day, down 3.3%. SPYs were down 2%, and Qs were down a little bit more than that. Interesting, the small caps really showed some nice outperformance on Friday, and didn't look that bad. And biotech also stood out like a sore thumb on Friday, and those did not have any follow through. In fact, those got hit pretty hard today. Here's where IWM sits. I figure I start with that one, just a little bit different, but again, just a big day. I think this was for the market, this was the biggest drawdown day that we've seen this year. And that's for the S&P. I got that from Ryan Dietrich on Twitter, but that's I think we had a bigger day for small caps, but still that breaks the threshold of moving inside the February value area. And we're basically right at the point of control at this point. I think we did take out, I like to look at the 1 hour time frame, very close to taking out that downside VPOC on the 1 hour time frame. I always get some questions about this. Of course, if you have any questions about using volume at price and how we do it with the value areas, and what's a version point of control, what's the 80% rule, just go right to my Twitter feed. You'll be able to find it there. All right, so here's my pinned tweet. You could learn where it says learn more here. You can click on this, and you'll be able to go through this in like 2 minutes. But basically, why version point of controls are so interesting, especially once you're trading outside of a range, as we're doing, they become very important, right? They're overhead supply. They could also act as a demand area. It's where previously a lot of buyers and sellers have met up, right? It's a very high volume area, and sometimes those high volume areas can act as sticking points, pivot points. All right, so we're going to go through a couple of them because when we have days like this, we tend to look for support areas. So let me go back to the S&P. All right, this is something that we've talked about for a while, this 3071 level, 4071 level. You've heard me talk about that for a couple of weeks, because we kind of came in here and we're holding it. We tested it back on the 10th. We came in on Friday. We tested it there as well, and we held. And today there was no doubt about it. We broke this thing with more conviction, and it just kind of kept going down for the day. And there wasn't, some of the things that we look for when we have days like this, and they can kind of just give you an idea of what kind of day you're going to get. And and that's kind of just what I summed up. I give updates throughout the day, and a couple of my just audio updates, I just said, hey, this doesn't look like this is going to be a very constructive upside day. I don't see a high probability that it's going to be at one of those buy the dip days, because interest rates were just going too high and the breadth was just extremely ugly for the day. But here's what it looks like on the 5-minute bar. You can see this kind of, just continue to kind of stay below here. We had a little bit of a lunchtime bounce. Remember, why does a lunchtime, why do we often see lunchtime bounces? It's because it's the latest volume time of the day. All right. So, for example, I use this quite a bit as an example, but one of the most widely used algorithms, and when I say algorithm, it's not a predatory algo or anything like that. It's just one of the orders that traders use frequently to get an order done, which is called the VWAP algorithm, right? You hear this now because the VWAP is used quite often now in technicals, but it really it's a trading algorithm, right? So for example, if you're looking to execute something over the day, a lot of traders will put that in what's called a VWAP algorithm, and it will slice the order up, throughout the session of the day, but it will trade more where there's a historic volume pattern. So that's the first couple hours of the day, and that's the last couple hours of the day. In the middle, it doesn't. In the middle of the day, around lunchtime, it doesn't trade much. So if the trend is down for the day, you might often see a little bit of a bounce, because if there's heavy selling pressure, there just won't be that selling pressure at lunchtime, and the market kind of floats up a little bit. All right, but and then once we come out of that, you could usually tell right around the first 15-20 minutes of the 1 o'clock hour, how the rest of the day is gonna, or what what the trend, if the trend is resuming or if it's changing. So we did take out, if we let this chart adjust, maybe it wasn't in S&P futures, but I did see this taken out in SPY. So a little bit different volume profile, because S&P futures trade more more throughout the trading day, right? In the after hours, S&P futures trade a lot more than SPY. But we did take out this version point of control. I don't see any major bounce from that. It's something that we might have to watch for tomorrow. Also, you want to look at NASDAQ too. There was a version point of control that was taken out here, but if you look at the Qs, I don't think it was very close to being taken out. Again, why is there a different volume profile for Qs and NASDAQ futures, even though they're the exact same underlying? It's because the volume, they trade different, they trade differently, or more volume at different times of the day, right? So therefore you're going to get a different volume profile, right, and different value area. All right, so very close to being that taken out. Interesting is that the Qs are still way above the value area for February. So again, just in case you missed what I was saying here, the S&P broke into value. I think the 200-day moving average and the 50-day moving average could provide some nice support in here. But I think it's going, again, I don't want to make any prediction, but I just think once you lose the momentum like this, and you move and you lose this channel, it takes a while to kind of straighten this out again. So even though we've got some support in here, which is the 50-day moving average and the 200-day moving average, which you could see a potential bounce from, it may just be that. It may just be a bounce, because now you've kind of lost all of this upside momentum, and you've also lost the channel in here. So I think patience is required, after that. And then again, here's IWM, which is also broken into the value area. Qs have not, even though that channel has been broken, they also have a test. So the next couple of days are going to be interesting, because you do have, things like the 200-day moving average that are coming into the picture that could provide, a place for a bit of a bounce. But very interesting when you look at sectors, which I'll get to in just a second. I wanted to cover bonds for a minute here, right? I always talk a lot about 30-year bond futures, but we could look at a couple different charts here. And when you look at, I mentioned I would bring up what the situation is here in bonds. So if we bring up the US, and you could see the different maturities here, 2, 3, 5, 7, 10, 20, and 30. You could see that rates moved, all throughout the curve. They actually moved the most. Rates jumped the highest in the 5 to 7. It's 15 basis points. That's not a small move. So again, this comes after, right? So now we'll move to the charts and we'll look at the long end of the curve. But this has been moving down since. So no surprise here that with bonds moving down from the beginning of the year and interest rates going higher, it's weighing on equities. We've seen this before. You've heard me talk about it. Again, really what I didn't want to see was the break of value back in here, which we did pretty decisively. TLT, there is, speaking of one of those virgin point of controls. So I put this on Twitter, and sometimes I don't, give you all the information behind here, but it's a potential bounce spot. Will we bounce here? I don't know, but I think there's a better chance to bounce on that red line there than without it being taken out. All right, and again, here was the move, the break below the value area. So we're still holding from this area from the end of the year, and I think that'll be interesting. But no doubt these are in downtrends, right? TLT got rejected right at the 200-day moving average, as did 30-year bond futures. All right, so that's the story in bonds, and again, I think that's a big piece of the puzzle. The dollar was also stronger today, but not ripping as high, as much as what we saw. But again, it's been gravitating a bit higher. Again, these things are kind of what I refer to when you see the dollar up and when you see yields higher as risk off. Let's just talk a little bit about sectors. What's interesting is the industrials got hit very hard today. They've been, they were talking about this earlier on CNBC, but this has been the leader of the market, in my opinion. The industrials have shown really good strength. They've also shown really good breadth, right? I run a screener at the end of the day that I put out on what do you call it? Substack, right? Sorry, it's been a long day. But you can sign up for that at on Substack. But I put out what's known as a screener that is a it's a breakout screener, right? I call it out of the box because it's when names are trading out of the value area on multiple time frames, but not super extended, right? We have that into our screen. But for the last month or so, we've seen nothing but industrials have been some of the strongest names. Financials have been in there too, and there's been a couple other sectors, but it's mainly been into industrial. So this kind of felt like, hey, maybe this got a little bit overcrowded. It's funny, I hear the argument all the time about, oh, this is all retail rally and so on and so forth. But I tell you, I've been trying to, when I put out industrial charts, I don't get a lot of interest from the retail crowd. So what's been making the industrials go up like this? I mean, I have to think that both the institutions and retail is involved in this rally. But yeah, this is not a high growth area, which is where most of the retail crowd is in. So, but it kind of just, it's interesting because finally we had some, what's another area that kind of looks interesting right now is the consumer staples. Even though they're kind of just sitting right in the middle of the value area, I see some opportunities in things like Church and Dwight that's trying to move above the value area and maybe can push up to this $87 VPOC. US Foods had an inside day today after real nice moves, and this has a potential to break higher, right? Possible breakout here. Another one that people like is this Lamb Weston, right? So again, the defensive areas outperformed a little bit, like the consumer staples today, but not by screaming higher. And what one area that I continue to think is kind of a head scratcher is the healthcare names. It's still even though this just continues to grind lower, just doesn't look like there's any appetite to kind of go into this group right now. right? So just kind of interesting, a couple other groups that I'll kind of close with. But there's your consumer staples. The Chinese internet group continues to move down, right? Got hit again today. This did take out a downside VPOC and is now right back into this, bull flag type area. It's just been steadily moving down as well, over the last month. Other standouts today, clean energy really got hit today. Biotech, and sometimes when I see stuff like this, and I was in a trade here, but really nice price action on Friday, and just look at it reverse and go the other way. The only thing that you could do with this type of situation, because this happens in all different types of charts, right, is just to have your stop, and when you notice it goes below either your cost basis or some other level that you're watching, don't mess with it. This thing closed on the lows today, down 4.6%. So, sometimes there are fake outs like that, and you just kind of have to monitor. And that's the best that you could do when you have a very tricky candle like that. All right, guys, that's it for today's video. Have a great night. See you tomorrow.